You're watching something that hasn't happened in gold markets in over a decade, and most investors have absolutely no idea it's coming. I'm talking about what traders call a God candle, that massive vertical price move that changes everything overnight, the kind of move that turns $50,000 into $150,000, the kind that makes early investors look like geniuses and leaves everyone else scrambling to catch up. And right now, every technical indicator, every fundamental driver, and every piece of institutional behavior is screaming that gold is about to experience exactly this kind of explosive move. Let me show you what's happening behind the scenes. Because what you're about to see isn't speculation. It's a mathematical inevitability that's been building for years. Gold is currently sitting at a critical inflection point. We're talking about price levels that have acted as resistance for months, levels where massive institutional orders are stacked, levels that once broken will trigger an avalanche of buying that could send prices vertical in a matter of days. The technical setup is almost identical to what we saw before gold's historic runs in 1979, 2008, and 2011. But this time, the fundamental backdrop is exponentially more powerful. Let me paint you a picture of what's really happening in gold markets right now. Because the mainstream financial media isn't telling you this story. They're too busy talking about tech stocks and crypto while the biggest wealth transfer in modern history is setting up in precious metals. Gold has been consolidating in a tight range for months now. Traders call this coiling. It's like a spring being compressed tighter and tighter. Every day that gold holds these levels, every failed attempt to push it down, every central bank purchase adds more pressure to that spring. And when it releases, the move is going to be explosive. Here's what makes this setup so powerful. Gold isn't just breaking out on technicals. It's breaking out while every fundamental driver that matters is aligned in the same direction. That almost never happens. Usually, you get technical breakouts that fail because fundamentals don't support them, or you get fundamental stories that don't translate to price action because the technical setup isn't there. Right now, we have both, and that's what creates God candles. Let's start with what's happening at the institutional level, because this is where the real story is. Central banks around the world are buying gold at a pace we haven't seen since the 1970s. We're not talking about small purchases. We're talking about hundreds of tons per quarter. China's central bank has been buying gold for 18 consecutive months. Russia has been accumulating aggressively despite sanctions. India, Turkey, Poland, Singapore, central banks that historically held minimal gold are now loading up like there's no tomorrow. Why? Because they see what's coming. They understand that the current monetary system is reaching its breaking point, and when that happens, gold is the only asset that maintains its value across regime changes. Think about what central banks know that retail investors don't. They have access to data we'll never see. They sit in meetings with other central banks. They understand the true state of sovereign balance sheets. And they're buying gold hand over fist. That's not a coincidence. That's a signal. But here's where it gets really interesting. While central banks are accumulating, commercial traders, the big banks and institutions that typically suppress gold prices, are reducing their short positions to levels we haven't seen in years. This is huge. These are the players who have historically kept a lid on gold prices through paper market manipulation, and they're stepping aside. They're covering shorts. Some are even going long. When the suppressors become buyers, you know something big is about to happen. Now let's talk about the supply side, because this is where the physical reality of gold markets becomes impossible to ignore. Gold production peaked years ago. The easy gold has been mined. New discoveries are rare and expensive to develop. It takes 10-15 years to bring a new mine online, and there aren't enough projects in the pipeline to meet growing demand. Meanwhile, demand is exploding, not just from central banks, but from retail investors in Asia who understand gold's role in wealth preservation. From institutions building strategic reserves, from countries looking to reduce dollar dependence. You've got declining supply meeting surging demand. That's economics 101. And the price adjustment required to balance that equation is going to be massive. Here's something most people don't understand about gold markets. The vast majority of gold trading happens in paper markets, futures contracts, ETFs, unallocated accounts. These are claims on gold, not actual physical metal. And the ratio of paper gold to physical gold is estimated to be somewhere between 100.1 and 250.1. That means for every ounce of actual gold that exists, there are 100 to 250 paper claims on that same ounce. As long as everyone's happy holding paper, the system works. But the moment people start demanding physical delivery, the whole structure collapses. And that's exactly what's starting to happen. Physical gold premiums are spiking in Asia. Delivery delays are extending. Vaults are seeing drawdowns. The paper market is slowly losing its grip on price discovery. When that breaks, and it will break, the price of physical gold is going to gap up so fast it'll make your head spin. We're talking about potential moves of hundreds of dollars in a single day. Let me tell you about what happened in 1980, because history doesn't repeat, but it sure does rhyme. Gold went from $200 to $850 in less than 2 years. That's a 325% gain. But here's what most people forget. The majority of that move happened in the final 6 months. The God candle phase. Investors who waited for confirmation, who wanted to see the breakout before buying, ended up paying $600, $700, $800 for gold that early buyers got at $200. They still made money, but they missed the life-changing part of the move. The same thing happened in 2008, 2011. Gold went from $800 to $1,900, but the explosive phase happened in the final 18 months. Early buyers doubled their money. Late buyers made 20–30%. The difference between generational wealth and a decent trade. Right now, we're in that early buyer phase. Gold is consolidating at highs, building energy, setting up for the explosive move. But the window is closing fast. Now, I want to take a quick 30-second detour here because this is relevant if you're thinking about retirement security. If you've got $100,000 or more sitting in traditional retirement accounts, 401ks, IRAs, that kind of thing, you might want to look into how gold IRAs work. I put together a free guide that covers the mechanics, the tax implications, how to get physical gold into your retirement account without penalties. It's in the description below. No pressure. But if that's your situation, it's worth understanding your options. All right, back to what's happening in gold markets. The geopolitical situation is adding rocket fuel to this setup. We're watching the de-dollarization trend accelerate in real time. Countries are settling trade in local currencies. The BRICS nations are building alternative payment systems. Saudi Arabia is accepting yuan for oil. Every one of these developments reduces global dollar demand and increases gold's role as a neutral reserve asset. This isn't a short-term trend. This is a structural shift in the global monetary system that's going to play out over years and decades. And gold is the primary beneficiary. Think about what's happening with sovereign debt. The United States has $34 trillion in debt and counting. Japan's debt to GDP ratio is over 250%. European nations are drowning in obligations they can't possibly repay. The only way out is inflation, printing money to devalue the debt. That's not a conspiracy theory. That's stated policy. Central banks have explicitly said they're targeting higher inflation. They call it average inflation targeting or flexible inflation frameworks, but it all means the same thing. They're going to print money until the debt becomes manageable in nominal terms. And when they do that, gold goes vertical. Because gold is the only asset that can't be printed, can't be devalued, can't be inflated away. Let's talk about the technical setup, because this is where traders are seeing the God candle forming. Gold has been testing resistance at record highs repeatedly. Each test holds. Each pullback finds support at higher levels. The consolidation pattern is textbook accumulation. Volume analysis shows institutional buying on every dip. The 50-day moving average has crossed above the 200-day, what technicians call a golden cross. Momentum indicators are building positive divergence. Every technical tool is flashing the same signal: breakout imminent. But here's what makes this different from normal breakouts. The resistance level we're testing isn't just a technical line on a chart. It's a psychological barrier that's held for months. When it breaks, it's going to trigger stop-loss orders, momentum algorithms, and FOMO buying all at once. That's what creates the vertical move. That's the God candle. I want you to understand the magnitude of what's possible here. If gold follows the same pattern as previous major bull markets, We're looking at potential moves to $3,500, $4,000, possibly higher. That's not wild speculation. That's what happens when you apply historical bull market ratios to current price levels. A move from current levels to $4,000 represents roughly 50% gains. But here's the thing about God candles. They don't move in straight lines. They gap up. They have days where gold moves $100, $150, $200. Days where you wake up and your position is up 10% before breakfast. Those are the days that create wealth. And you can't catch them if you're not already positioned. The mining stocks are going to be even more explosive. When gold moves 50%, quality mining stocks typically move 150, 200%. That's the leverage effect. And right now, mining stocks are trading at valuations that haven't been this cheap relative to gold prices in decades. We're talking about companies producing gold at $100 and $200 per ounce, selling it at $2,700, and trading at valuations that assume gold is going back to $1,500. That's not rational. That's opportunity. Here's what I'm watching for the trigger. It could be a geopolitical event, a major conflict, a currency crisis, a sovereign default. It could be a technical breakout that triggers algorithmic buying. It could be a major institution announcing a significant gold allocation. The specific trigger doesn't matter. What matters is that all the conditions are in place. The spring is coiled. The fundamentals are aligned. The technicals are set up. The institutional positioning is ready. When the trigger comes, the move is going to be fast and violent. Let me tell you what happened to investors who waited in 2008. Gold was trading around $800 in October. The financial crisis hit. By December, gold was at $900. People said, "I'll wait for a pullback." The pullback never came. By March 2009, gold was at $1,000. By December 2009, it was $1,200. By 2011, it hit $1,900. The investors who waited for the perfect entry, who wanted confirmation, who needed to see the breakout before buying, they ended up paying $1,400. $1,400, $1,600 for gold that early buyers got at $800. They still made money, but they missed the God candle. They missed the phase where wealth is created. Right now, we're in that pre-breakout phase. Gold is consolidating at highs. The fundamentals are stronger than they were in 2008. The technical setup is cleaner. The institutional positioning is more bullish. Every indicator is flashing green. But the crowd is waiting. They're waiting for confirmation. They're waiting for the breakout. They're going to wait themselves right out of the best entry point they'll see in this entire bull market. Here's what smart money is doing right now. They're accumulating. They're building positions. They're not trying to time the perfect entry because they understand that missing the God candle is far more expensive than buying a few percent too early. Think about the risk reward here. If you buy gold at current levels and it pulls back 5%, you're down 5%. But if you wait and it gaps up 20% on the breakout, you've missed a 20% gain trying to avoid a 5% drawdown. That's not smart risk management. That's penny wise and pound foolish. The opportunity cost of waiting is massive. Every day you're not positioned is a day you're betting against every fundamental driver, every technical indicator, and every piece of institutional behavior that's screaming this move is coming. I'm not saying gold can't pull back. Markets can do anything in the short term. But I am saying that the setup for a major explosive move is as good as it gets. And when that move comes, it's going to happen faster than most people can react. Let me paint you a picture of what the next 12 months could look like. Gold breaks through resistance at $2,700. That triggers momentum buying and stops out the remaining shorts. Price gaps to $2,150 in a matter of days. Mainstream media starts covering it. Retail investors start paying attention. Gold consolidates briefly at $2,900, then breaks through $3,000. That's a psychological level that brings in a new wave of buyers. Suddenly, gold is the story everyone's talking about. CNBC is running gold segments. Financial advisors are getting calls from clients asking about gold exposure. By the time gold hits $3,500, the move is obvious to everyone. But the easy money has been made. The God candle has happened. The investors who bought at $2,600 have made 35%. The ones who waited until $3,000 to get confirmation have made 15%. That's the difference between positioning before the move and chasing after it's obvious. Here's what I want you to understand about God candles. They don't announce themselves. They don't wait for everyone to be ready. They happen when the conditions are right, and the conditions are right now. Every piece of data, every chart pattern, every fundamental driver is pointing to the same conclusion. Gold is setting up for a major explosive move, the kind of move that happens once or twice a decade, the kind that creates significant wealth for those positioned ahead of it. The question isn't whether this move is coming. The question is whether you're going to be positioned when it happens. Central banks know it's coming. That's why they're buying. Commercial traders know it's coming. That's why they're covering shorts. Smart money knows it's coming. That's why they're accumulating. The only people who don't know are retail investors who are waiting for confirmation, waiting for the perfect entry, waiting for someone to tell them it's safe to buy. By the time it feels safe, the God candle will have already happened. The explosive phase will be over. The easy money will be made. This is your moment. This is the setup. This is the opportunity that you'll look back on in 12 months and either celebrate because you acted or regret because you waited. The God candle is coming for gold. The only question is whether you'll be positioned to profit from it or watching from the sidelines wishing you had acted when you had the chance. The choice is yours, but the window is closing fast.